I'm Alex Burton, and this is the Business File, and this is a health report. Not of a person, but of a business. Actually, it's a financial statement, the nature of which we'll be examining a little later on. Our program today is about the accounting function and how it's used. Every business needs a system that provides accounting information. Anyone involved in a business has to be able to measure how it's doing compared to how he or she thinks it's doing. Accounting provides that information. Should production be increased? Are personnel costs too high? Where can spending be reduced? And to find out how business managers use accounting to answer these and other questions, we'll be speaking today with an accounting authority in California and a financial manager in Texas. And we'll also be examining two of the most basic sources of accounting information and their practical business functions. First, though, we're going to Palo Alto, California to visit Charles Horngren, professor of accounting at Stanford University and the author of several major accounting textbooks. Professor Horngren, thank you for taking the time to join us today.
Thank you, Alex.
As a starting point, I'd like you to clarify something for me. Many people think that accounting and bookkeeping are synonymous. Are they?
Heavens, no. I would compare bookkeeping with arithmetic in the following sense, that if you take the whole field of mathematics, arithmetic is a part of the field. If you take the whole field of accounting, bookkeeping is a part of the field, but it's really a very minor part. And when you take, for example, formal education in accounting at the university level and you think of all of the courses that are offered, the bookkeeping aspect is a couple of weeks and no more.
All right. Obviously, accounting involves more than bookkeeping. Just what functions does it involve?
Accounting is a systematic and efficient way of gathering information and recording it and summarizing it and reporting it and interpreting it for interested parties. And it's usually done by means of what is frequently called an accounting system.
Well, our main focus in this program is on how management uses accounting, but there are other groups who also need accounting information. Who are they, and what are their interests?
Well, you and I and a lot of other people painfully know that the income tax authorities are very much interested in accounting. And you have to report income. Businesses have to report income. And without accounting, the whole area of the income tax would just fall of its own weight. And certainly in the investment public, the owners, the shareholders, lenders, such as the bankers, want to know about accounting. And so all of these parties are probably the prominent users of accounting information. And recently, a lot of publicity has been given to trade unions who have had some tough negotiations and are interested in the accounting numbers of managements who claim that they are on the brink of bankruptcy and they've got to get lower wages in order to survive.
All right, but let's turn to managers now. What sort of information do they need?
Well, managers are interested in answers to various questions, and I like to divide those questions into three categories. One is the scorekeeping question. That is, how well am I doing? Where am I in terms of my financial status? A second kind of question is an attention-directing question. That is, what problems should I look into? What should I worry about? And the third category of questions is a problem-solving category. That is, of the alternative ways of getting something done, which way is the best? Accounting helps answer those questions. It's a major way of answering those questions.
How different is the information managers need from what the other groups need?
The information usually gets much more detailed because managers are concerned with the details of their operations, whereas the income tax authorities and outsiders, outside owners, for example, are not as concerned. They are also, managers are interested in not only the past, but the future. And so they are concerned about planning in terms of how much income they're able to generate in forthcoming periods, and where is the money going to come from in order to pay my bills and repay the loans. So there's a definite future orientation on the part of managers that isn't shared with the same degree of interest as the other parties.
You've told us what information a manager needs and why he needs it, but where does he go to get it?
There are many sources of information, but there are two well-known major financial reports. One is called the balance sheet, and the other is called the income statement.
Professor Horngren, later I want to discuss with you the uses of these reports. First, though, we need to illustrate what they are. To provide the various constituencies of a business a health report on the business, an organization develops two general-purpose financial statements, a balance sheet and an income statement. The balance sheet is like a snapshot, a photograph of a business at a moment in time. It shows the financial picture of a business on a particular day, a New Year's Eve, for instance, as though the wheels of the company were momentarily at a standstill. It indicates the health of a business, what it owns and what it owes. It does this by comparing the company's assets to the claims against those assets in the form of either liabilities or owner's equity. The balance sheet is divided into two sides. On the left are shown assets. On the right are shown liabilities and owner's equity. In the assets column are all the goods and property owned, as well as claims against others that are yet to be collected. Under liabilities are all debts owed by the company. Under owner's equity is the amount or share of the assets that would be left to the owners if the business were to pay off all its liabilities today. Both sides are always in balance. Let's examine each section more closely. Assets are a company's resources, what has been invested in and earned by the business. Resources the company has available to use in the future. Assets can either be current or fixed. Current assets include cash and other assets which, in the normal course of business, will be turned into cash in the reasonably near future, within a year from the date of the balance sheet. Current assets include cash, bills and silver in the till, and money on deposit in the bank. Marketable securities, temporary investments of excess or idle cash in commercial paper and government securities. Accounts receivable, amounts not collected from customers to whom goods were shipped prior to payment. Inventories. For a retailer, this includes the dollar value of stock to be sold to consumers. For a manufacturer, it is composed of raw materials to be used in the manufacturing of a product, partially finished goods in process, and finished goods ready for shipment to customers. These assets together are the total current assets of the company. The second category of assets, fixed assets, is often referred to as property, plant, and equipment. It represents those assets not intended for sale, which are used over and over again in order to manufacture the product, display it, warehouse it, transport it. This category includes land, buildings, machinery and equipment, furniture, automobiles and trucks. Each is listed on the balance sheet at its acquisition cost, less its decline in useful value due to wear and tear from use, passage of time, and obsolescence. When this depreciated value or depreciation is subtracted from the fixed assets, it results in net fixed assets. The total of current and fixed assets is one side of the balance in the balance sheet. This is what the business owns. The other side, or counterbalance, is the claims against the assets. The claims can be liabilities or owner's equity. Liabilities are the claims by those who have provided goods, services, funds to the business, the creditors. Liabilities can be current or long-term. Current liabilities include all debts that fall due within a year. It is the companion to short-term assets because current assets are the source from which payments are made on current debts. Current liabilities include accounts payable, the amounts the company owes to its regular business creditors from whom it has bought goods. Notes payable, the money owed to a bank or other lenders if it has borrowed money. Accrued expenses payable. On any given day, the company owes salaries and wages to employees, interest on funds borrowed from banks, fees to attorneys, insurance premiums. The sum of all these is total current liabilities. Long-term liabilities are debts due after 1 year from the date of the financial report. Long-term liabilities may include notes payable, mortgages, and any other long-term obligation. The two, current and long-term liabilities added together, are, of course, the total liabilities. Owner's equity is the claims held by those who own the business. It represents the capital contributed by the owners, or in the case of a corporation, the stockholders, and profits retained within the company. In other words, it is the company's net worth after subtracting all the liabilities. The balance sheet serves as a check and balance for the accounting records to ensure everything is recorded accurately. It accounts for the resources and where they came from. The total assets, what the business owns, equal the claims or what it owes. Liabilities and equity on the other side. Now, while the balance sheet shows the financial position of a business on a given day, a snapshot of a moment in time, the income statement is like a movie. It covers a business over a period of time, from last New Year's Eve to this New Year's Eve, or from January the 1st to January the 31st. The income statement, also referred to as the earnings report or the statement of profit and loss, is a scorekeeping statement. It shows how much profit or loss a business has made, how the money was made, how it was spent during that period of time. It helps to connect two balance sheets by recording the performance of a company between the balance sheet dates. Now, let's continue with our illustration. The income statement matches the amounts earned from selling the goods and other items of income against all the costs and outlays incurred to operate the company. The result is a net profit or loss for the period. The income statement consists of two parts: revenue and expenses. Revenue is a business's income from its primary source, usually sales. It represents the source of money to the company from its customers for the goods and services rendered. From this, the company subtracts its cost of goods sold, the cost of purchasing stock for a retail business, or the cost of converting raw materials into finished products for a manufacturer, to determine its gross profit. Gross profit is the percentage of markup the company has to cover its operating expenses. If this is lower than planned for, either the price of products sold needs to be increased or the cost of goods needs to be lowered. Operating expenses in the form of selling and general administrative expenses need to be accounted for. Selling expenses include salesmen's salaries, commissions, advertising and promotions, travel and entertainment. General and administrative expenses includes executive salaries, office payroll, office expense. In addition, the expense of owning and operating the property, called depreciation, must be accounted for. The total of these expenses is total operating expenses. This, in turn, is subtracted from gross profit to determine net profit or loss from operations. If the company has additional sources of income, from dividends or interest from investment in stocks or bonds, it's listed under other income. If the company pays income tax, as in the case of a corporation, this would be listed here. The adjusted total is the total profit or loss of the company. It's also called the bottom line. Now that we've seen just what an income statement and balance sheet look like, we're going to find out how they're used. Joining Professor Horngren and myself now in Dallas, Texas, is Steve Corby, who is Chief Financial Officer of Tecton Industries, a maker of electronic parts and supplies for industry. Besides his position at Tecton, Mr. Corby has served as an officer and advisor to a number of different firms. Mr. Corby, thanks for being with us.
Thank you, Alex.
Gentlemen, we've just finished going over examples of the balance sheet and income statement, and by now I think we've got a good idea of the information they provide. But what I'd like to do in this segment is go into the significance of the information. Professor Horngren, what is the value of the information we get from these documents?
Well, that kind of information helps answer those three categories of questions that I referred to earlier, and the scorekeeping question. How well have I done? Where do I stand? The attention-directing question. Now, given these financial reports, what should I worry about? What should I look into? And, of course, the third category, the problems of the several alternative ways of doing something, which way is the best. An income statement, for example, can be divided into many categories. Various product lines. You can visualize in a department store various departments. What departments are doing well? What aren't? Which ones aren't doing well? What should I do about it?
Mr. Corby, speaking as a financial manager, what's the value of this information to you?
A balance sheet is generally just a snapshot of a company's financial position at a point in time, and by itself is not of very much value. A series of balance sheets showing how a company's financial position has changed over time is valuable. The elements of certain elements of a balance sheet are important in that they have to be monitored on more than a monthly or a quarterly basis, and in fact probably on a daily basis. That's being the cash position of the company, the accounts receivable and accounts payable. The income statement is more valuable. Its primary value is in that you have a historical record of what you did and compared against what you thought you could do, what you planned in your budgeting process that you were going to do for that period. The value of the income statement is primarily in seeing the relationship among the various categories of the income statement to the sales and revenue, what the percentage relationships are. And it varies from business to business as to what those percentages and what those relationships should be, whether it's an inventory business or a service-oriented business.
What relationships would those be? Give us some examples.
Well, in a manufacturing, retail, distribution type business, the key information on an income statement is the relationship between the cost of goods sold and the sales and revenue. There is no one specific relationship that needs to be. It depends upon the nature of the business and the other types of costs that are involved. The other elements of selling expense and general administrative expense and financing expense, interest, to sales and revenue are important, but the most important is the relationship between cost of goods sold and sales.
All right. Once you've got the information, how do you use it?
Well, financial statements are generally used in basically two ways. The external uses of the financial statements of providing information to the capital sources, the banks and investors, and other people who have a need for those for that information. The internal uses, however, are probably the most important in order to provide the information on a current basis to people that are managing the business, to be able to understand how you're performing versus how you thought you were going to perform.
Let's discuss these internal uses. The people that are managing the business, what information do they need?
Different managers in different parts of the business have needs for different information. The manager of production doesn't need to know about how accounts receivables, the status of accounts receivable. But he does need to know what the cost of the products that he's manufacturing is. And is that cost what we think the cost should be? Is it what we expected in the process?
Professor Horngren, Mr. Corby just brought up an important point. Different managers have different needs. I'd like to go deeper into this. What are the basic differences between managers and their needs?
That underscores the fact that there are really two major responsibilities of managers of business. One is called an operating management responsibility. The other is called a financial management responsibility. And if you don't do an adequate job, at least an adequate job in both types of responsibilities, your business is going to get in trouble sooner or later. The income statement is the primary financial report that tracks how well you're doing as an operating manager. The balance sheet and the statement of changes in financial position tracks how you're doing as a financial manager. There are lots of companies, particularly companies that have just started, for example, or just barely been in business for a year or two, that get into trouble, not because their operating management has been substandard, but because their financial management has been substandard. That is, they'll sell a lot, but they'll find that they can't collect the money from the customers who bought from them on credit. Or they'll buy a lot of inventory, and they'll do well in terms of sales, but they'll have far too much inventory and suddenly find that a lot of it is becoming obsolete. That's this matter of collecting money, the matter of inventory management. Those are financial management problems more so than they are operating management problems.
You just mentioned something I'd like to find out about, the statement of changes in financial position. What is that? How is it used?
It's a required statement for companies, for example, that are publicly held. You routinely see that statement as a part of their corporate annual report, and it answers the question, it's where did the money come from? Where did it go? Over a span of time. So it is like the income statement in that it covers a span of time, but it focuses on financial management as distinguished from operating management responsibilities.
What other accounting tools should we know about?
Another thing that managers particularly are concerned or is concerned with is the budget. And the budget really is a set of projected financial statements. What is the income statement going to look like next year? The statement of changes in financial position next year. Where am I going to be with respect to my balance sheet a year from now? This kind of budget discipline is an ingredient of well-managed companies. The budget is the major tool that managers use to give discipline to their planning. It forces them to plan. And that is its principal contribution to good management. Without budgets, businesses tend to hurtle from one crisis to the other. A lot of crises can be avoided entirely if budgeting has been done carefully.
Mr. Corby, do you agree or disagree? In your experience, how important is budgeting to a business?
The key element of any financial system and financial making decisions on the basis of financial statements is a good budgeting process. To be able to sit down at the beginning of a period and decide what you're going to do during that period in the way of revenues and costs, and to make, because you have to make certain assumptions as to the external markets and the internal cost factors. That's a valuable process and an essential process, because as you go through it, you have to be able to compare what is actually happening on a current basis to what you thought was going to happen, and to be able to answer the question as to why is it different? What are we doing, and what do we need to do to make it better?
Gentlemen, I'm afraid that's all the time we have for this discussion. Thank you both very much for your contributions. It's been highly rewarding. Professor Horngren?
Thank you. I've enjoyed every minute of it, Alex.
Mr. Corby?
Thank you, Alex. I enjoyed it.
You can't find out the health of a business just by looking at it. To really know, you have to look at its insides. That's what accounting does. Accounting is the tool that provides the information the manager needs to understand how his business is doing, how healthy it is. A doctor's health report tells us what our physical problems might be, say overweight, and what we can do about them, exercise more. The balance sheet and the income statement and other accounting information do the same things for business. They can spot a small problem and show how to keep it from becoming a big problem, but only if the person running the business pays attention to its health report. For this program, that's the bottom line. And until next time, I'm Alex Burton, and this has been The Business File.
The preceding program is part of a college credit course.